It's Saturday evening, January 18th, 2026, and I'm going to come in hot because what happened on Thursday and Friday wasn't just another good week. It was the kind of market glitch that shows up right before a sector goes from ignored to unavoidable. If you were distracted for a couple of hours, you missed the opening snap of what I believe could turn into the most violent repricing the silver mining space has seen in years. Here's the deal. The metal didn't do anything crazy. Silver held the line. But the miners? The miners threw a chair through the window. And if you're thinking, okay, John AG, that sounds dramatic, good, because this is dramatic, and it matters. Because once a move like this starts, you don't get a polite invitation later. You either understand the mechanics early, or you end up chasing headlines after the easy money is gone. Quick favor before we get into the meat. My YouTube stats still show a huge chunk of you watch every week and never hit subscribe. If you value the work here, subscribe and drop OG John AG in the comments so I know you're part of the real crew. All right. Now let's walk through what just snapped, why it snapped on options expiration, and why the next couple of weeks could get even wilder, especially once earnings start landing. Also, check the description after this video. I left bonus links there for you, including the premium WhatsApp channel link and the option to join channel membership if you want the deeper stuff. Now, I want you to picture Thursday, January 16th, monthly options expiration, OPEX. That's the day a mountain of derivative bets either cash out quietly or blow up loudly. It's the day where positioning becomes real, and it's the day I've been telling you to watch because OPEX is where the market stops pretending. Thursday morning opened like a classic trap. A fast hit, a sharp drop. Silver got smacked down in minutes, down roughly a couple bucks in a blink. Exactly the type of move that's designed to trigger stops, shake weak hands, and keep key call options out of the money. And for a short stretch, it looked like the hit worked. Price hovered under the level the shorts needed. The miners went flat to slightly red. The mood got quiet. The noise machine started warming up. But then, something changed. Late morning, buying showed up that didn't feel like retail. Not a bunch of tiny orders. I'm talking blocks, real size, big prints. The kind of orders that don't care about your feelings and don't ask permission. Silver clawed back. And by the time the session was heading into the close, it wasn't just back. It was above the line that mattered. Silver closed above that key strike zone, and that single fact flipped a whole chain of exposures from safe to oh no. Because when silver finishes OPEX above a major strike, you don't just get a price move. You get an accounting problem, and markets hate accounting problems. Now, Friday, January 17th was the confirmation punch. The Silver Miners ETF ripped about 8.3% in one session, while silver itself was only up about 2.1%. Read that again and let it sit. Miners moved roughly 4 times the underlying metal in a single day. That is not casual price action. That's not investors are optimistic. That's forced behavior. That's hedging. That's positioning. That's desks scrambling to not get carried out. And if this is your first time hearing the phrase gamma squeeze, don't worry. I'm going to explain it in plain English, with the simple mechanics that matter, without turning this into an options textbook. But first, pause right here and ask yourself one question. If miners can move 4 times faster than silver on a day when silver barely budged, what happens if silver actually starts moving? Because that's the cliffhanger nobody wants to say out loud. Now, the mainstream crowd will try to frame this as a random bounce. They'll say, risk on, sector rotation, technical breakout, whatever phrase helps them avoid the real story. But the real story is mechanical, and mechanics don't care about opinions. The primary claim I'm making tonight is simple. Friday wasn't a one-day wonder. It was the opening act of a multi-week forced repricing that could feed on itself, especially if momentum persists into earnings season and into the next round of hedging. So let's break down Thursday first, because Thursday is the key to everything that followed. On Thursday morning, you got that fast, nasty dip, the kind of dip that shows up suspiciously around the time a market is trying to pin an option strike. You saw price drop quickly and then stall. That stall is the tell. When a market stalls in a strike zone during OPEX, it's not natural. It's positioning. The goal for dealers short call options is simple. Keep price below the strike so the calls expire worthless. If calls expire worthless, the seller keeps the premium. If calls finish in the money, the seller owes shares or owes hedges. And owing hedges is where things get dangerous, because when you sell calls, you can end up short gamma. Short gamma basically means, as price rises, your risk rises faster than your comfort. So to control that risk, you hedge. And your hedging becomes buying. And your buying pushes price higher. And higher price increases the hedge requirement. And that, right there, is how a squeeze gets born. Think of it like this. The option seller thought they were selling fireworks with no matches nearby. But price moved into the matchbox anyway. And now, everybody's holding a lit fuse. Here's the crucial part most people miss. Market makers don't hedge on vibes. They hedge on delta. Delta is just a number that tells you how much an option behaves like the stock. Out-of-the-money calls have low delta. That means you don't have to hedge much. But when price climbs toward the strike and goes in the money, delta rises fast. And that forces the dealer to buy shares to stay neutral. So if a dealer sold a pile of calls thinking they'd expire worthless, they may have been lightly hedged. But when price closes above the strike, they suddenly have to get heavily hedged. That means a lot of forced buying in a short window at the worst possible time. And when many dealers are in the same position at the same strike, the buying isn't gentle. It's synchronized. And synchronized buying is what turns a normal rally into a face melter. That's why Friday's move matters, because Friday looked like dealers starting that forced hedging process. And if the underlying remains supported, the hedging can continue. Let me put actual numbers on this, because numbers are what separate a squeeze from a fairy tale. On Thursday, the key psychological level was $90. That's where a massive pile of call options were sitting, waiting to either die quietly or turn into a problem. Silver dipped under it in the morning, and for a moment, it looked like the pin was going to work. Then the bid showed up. By the close, silver didn't just recover, it closed around $91.73, high enough to flip a long list of strikes from worthless to valuable overnight. And if you want the timestamp that made my ears perk up, around 9:47 a.m. Eastern, that sudden flush that felt like a stop run. Price slid from about $91.30 to about $89.15 in under 10 minutes. Classic shake the tree action when someone needs price below a line on a deadline. But here's what made Thursday different. The tree didn't drop the fruit they wanted. It snapped back. Then, around late morning, call it the 11:30 zone, you started seeing larger prints, real blocks. And once those hit, the tone shifted from weak to stubborn. By 1 p.m., silver was back over $91. Into the close, it held. That close is what lit the fuse. Now Friday's close is the scoreboard. Silver, up about 2.1%. SIL, the Silver Miners ETF, up about 8.3%. That's roughly a 3.95 to 1 leverage move in a single session. And here's the kicker. At these silver prices, the sector's operating leverage suggests miners can respond even more aggressively, 5 to 1 or 6 to 1 in bursts, once earnings confirm margins and once dealer hedging runs deeper. So if Friday was almost 4 to 1, it's not crazy to ask, was that day one or was that the warning shot? Now let me give you the practical mechanics in one clean loop. When options are out of the money, dealers can stay lightly hedged because delta is small. But once price moves in the money, delta rises, and the dealer must buy shares to remain neutral. That buying pushes price up. As price rises, more calls go in the money. Delta rises again. The dealer must buy again. That's gamma. Gamma is the acceleration of the hedge requirement. In a squeeze, gamma is the engine. And you don't need a conspiracy for this to happen. You only need crowded positioning at a popular strike plus a close above that strike. The math does the rest. Now, because you're going to see a lot of what would you do questions in the comments, I'll share the framework I'm using without telling you what you should do. My first checkpoint is Tuesday's open, because in this narrative, Monday is a market holiday. If SIL gaps up on Tuesday and holds the gap through the first hour, that's continuation. My second checkpoint is the $16 zone in SIL, because that's roughly where it closed after the Friday rip. If we pull back and that area acts like a trampoline, buyers step in quickly, that's healthy. If we break it and can't reclaim it, the squeeze thesis weakens. And my hardline level, if I'm forced to define one, is around 1450 on SIL. A close under that kind of level would tell me the move has failed structurally. Again, not advice, just the way I think about risk when volatility turns savage. Then we hit the fuel, earnings. Late January is where the market stops debating and starts reading. A big U.S. primary producer is expected to report around January 28th. A popular high beta name reports around January 30th. If those prints show the cash flow the margin math implies, that's when analysts update targets, and that's when bigger money starts caring. Because here's the truth. A squeeze can start a rally, but earnings can legitimize it. A squeeze is a spark. Earnings are the gasoline. And if both show up at the same time, you get the kind of chart that moves too fast for normal brains to accept. So keep your eyes on the scoreboard next week. If miners keep outrunning silver, if dips get bought, and if we walk into earnings with price holding up, this could be one of those rare windows where the market hints before it goes fully mainstream. Now let's talk about the other lever here, operating leverage. Operating leverage is why miners can outperform the metal massively once the price gets high enough. It's basic business math. Miners have costs, and they sell a product. When the product price rises while costs rise slower, profits explode. And if profits explode while stock prices have been asleep, the stock has to catch up, eventually. The market can ignore reality for a while, but it can't ignore earnings forever. Here's a simplified framework using the numbers we're working with. Silver around the low to mid 90s, and all-in sustaining costs for many big silver miners in the neighborhood of the low 30s per ounce. At those levels, the profit per ounce isn't a little higher, it's massive. And compared to periods where silver was far lower, you're talking about companies going from barely breathing to printing cash. Now look at what the stocks did over that same time frame. Many of them are not priced like cash machines, they're priced like survivors. That disconnect is the gap. And gaps in markets don't just sit there forever like a polite spreadsheet. They tend to close violently, because once the crowd sees it, everybody tries to buy the same thing at the same time. And right now, the crowd still isn't in it. That's the entire point. Now, I want to address something directly, because I know there are skeptics listening, and I respect skepticism. Skepticism keeps you alive in markets. Skeptic argument 1. Costs are rising. Inflation eats margins. Miners won't actually make as much as you think. Yes, costs rise. Diesel, labor, equipment, nothing is cheap. But ask yourself this, did those costs triple? Because silver went from the 20s to the 90s in this narrative. Costs didn't triple. Costs did not keep pace with that kind of price surge, which means margins expanded, which means cash flow expanded, which means valuations that assumed pain become valuations that need to assume profit. Skeptic argument 2. Governments will take the profits. Windfall taxes, resource nationalism. That risk exists, and it's not imaginary. But two things matter: timing and diversification. Policy takes time. Markets can reprice faster than governments can legislate. And many major miners are spread across jurisdictions, not sitting in one single country with one single political risk button. Skeptic argument 3. Big players won't allow the rally, they'll smash it again. I get the cynicism, but even games with referees have physics. Physical supply, physical demand, physical delivery, those are hard constraints. If paper positioning gets stretched enough, stress shows up. And when stress shows up at the wrong time, like OPEX, things break. Now, before we keep going, let me slide in something creative for the people who love these stories. If you want silver-related success stories, real people, real wins, real lessons, there's a link in the description to another channel that focuses on that. If that's your thing, subscribe over there too and binge it. All right, back to the squeeze. What makes a gamma squeeze special is that it can turn into a feedback loop. Buying forces more buying. Hedging triggers more hedging. That triggers momentum algorithms. Algorithms trigger stop losses on shorts. Shorts cover. Covering pushes price higher. And higher price forces even more hedging. That's why I'm not treating Friday like a random green candle. Friday looks like ignition. Now, what would confirm that this is not just noise? The first confirmation is continuation, especially if the miners keep outperforming the metal. If silver is up 1% and miners are up 4% again, that tells you the lever is still active. The second confirmation is how dips behave. In normal markets, dips linger. In squeezes, dips get swallowed. Buyers show up fast because hedgers need to buy on weakness. The third confirmation is earnings season, because earnings force the narrative to change. You can hide from charts. You can hide from vibes. You can't hide from a cash flow statement. In the final week of January, we're likely to see major miners report Q4 results. And if those results show what the margin math suggests, analysts will be forced to update models, funds will be forced to rebalance, and that creates another wave of buying that can stack on top of the squeeze pressure. Now, let me paint the sequence I'm watching, step by step, because retention comes from clarity. Step 1. OPEX pin attempt fails. Price closes above the critical strike zone. That happened. Step 2. Dealer hedging kicks in. Miners explode relative to metal. That happened Friday. Step 3. The market tests whether that move is real. Either it fades fast or it holds and pulls in momentum capital. Step 4. Earnings add gasoline. If earnings surprise to the upside, the repricing becomes fundamental, and that's when bigger pools of money feel safe stepping in. Step 5. Once the crowd shows up, the move becomes reflexive. That's where you get the really ugly green candles. Up days that make no sense until you remember, forced buying doesn't ask your permission. Now here's where people get hurt. They wait for mainstream coverage. They wait for a safe entry. They wait until everyone on their feed is talking about it. And by then, the easy phase is over. So let me ask you one question you can answer in the comments. Do you want updates on silver miners only when the move is already obvious? Or do you want them right when the mechanics flip? Tell me which you prefer and why. And here's a second question. What's your biggest mistake in past bull runs? Buying late, selling early, or getting shaken out by fake dips? Drop it below. Your answer could save someone else from repeating it. Now I'm going to put a spotlight on the leverage gap again, because this is the part that creates virality when it finally clicks for people. If the miners move nearly 4 times silver on Friday, that suggests the market is finally waking up to the profit explosion happening inside these companies. But And this is important. The math says the leverage can be even higher at these silver prices, which means Friday's move, as loud as it was, may still be the beginning, not the peak. That doesn't mean it's a straight line up. Squeezes are ugly. They whip, they shake, they try to break you emotionally. But the structure is what matters. Higher lows, violent rallies, fast dip buying. Now, what about the catch? Every trade has a catch. The catch is volatility. The catch is headline risk. The catch is the market trying to scare you out right before the next leg. The playbook is predictable. Once the miners pop, you'll see a wave of overbought warnings. You'll see take profits pieces. You'll see the rally is done hot takes. The goal isn't to inform you. The goal is to make you sell so someone else can buy. And I'm not saying that because I think there's a conspiracy behind every candle. I'm saying it because I've watched the emotional cycle repeat for years. Early rally gets dismissed, continuation gets doubted, then late stage hype arrives, and that's when the crowd buys tops. So what's the smart move? It's to focus on mechanics and levels, not emotions. Now, I'm not your financial advisor. I'm not telling you what to buy. I'm telling you what I'm watching. If the miners hold the breakout levels and dips get bought quickly, that supports the squeeze narrative. If the move fails and closes back under key levels for multiple sessions, that tells you the ignition fizzled. But right now, the evidence we have is ignition. Now let's talk about the part the mainstream avoids. Why would this happen now, specifically? The simplest answer is positioning plus stress. Options exposure was stacked. Price refused to break down. That forced hedging. And once the hedging started, the sector reacted like a compressed spring. Now, there's also the broader backdrop. Physical market tightness and premium behavior. When premiums on physical products stay elevated, that's a signal of stress somewhere in the supply chain. When inventories at major exchanges trend down over time, that's another form of stress. Stress doesn't guarantee a moonshot tomorrow, but stress increases the odds that paper games run into reality at the worst possible moment. And OPEX is one of those moments. Now, since we're talking about staying ahead of the herd, here's where the deeper resources come in. If you want the more detailed breakdowns and the extra research we don't always put in the public uploads, we offer members-only videos too. There's a separate team working on those, and they go heavier on the digging. Those are for premium members who want more than surface-level recaps. And again, the description has bonus links, including the premium WhatsApp channel and the channel membership option. If you like being early, those are worth checking out. Now I want to take a minute and talk directly to the people who are actually winning, because you are one of the most underused weapons on YouTube. If you're doing well, whether you nailed a trade, built a stack, grew your income, whatever, share your success in the comments. I'm serious. Seeing real wins lifts morale, and it gives the community proof that discipline works. And later in the video, I'm going to ask you again, because I want this comment section to be useful, not just noise. Okay, back to the market story. When miners lag, it frustrates people. They watch silver run and they wonder why the equities don't move. And then, when the catch-up finally starts, it's so fast it feels unfair. That's the historical pattern. The metal leads, the miners lag, then the miners sprint. In previous cycles, you saw long periods where miners chopped sideways while the commodity climbed. Analysts stayed cautious. Funds stayed underweight. Retail ignored it. Then the earnings proved the margins. Then the re-rating happened. Then the move went vertical. That's why I keep coming back to earnings season as the next big catalyst. Because earnings don't care how many times someone said overbought. Earnings are numbers. Now, let's make this concrete with a simple valuation thought experiment. Imagine a miner producing tens of millions of ounces, selling into a price environment in the 90s, with costs in the 30s. That miner's per ounce profit is huge. Multiply that by production, and you get a profit number that makes the current market cap look tiny. When a company is generating massive profit and trading at a cheap multiple, one of two things happens. Either the profit collapses, or the stock revalues higher. If silver holds, profit holds. If profit holds, the multiple eventually expands because investors are addicted to earnings. Now, what about the timing next week? We have a holiday on Monday in the narrative, which means hedging activity compresses into fewer sessions. Fewer sessions with the same hedging pressure can create more violent daily moves because dealers don't get to spread their buying out comfortably. Tuesday becomes a key day. If we see a strong open and the miners hold gains through the first hour, that's a sign the squeeze pressure is still active. Midweek is when the counterpunch usually comes. If someone wants to stop a run, they try to hit it when enthusiasm is high. That's when you get engineered dips designed to shake out late buyers and scare the early ones. And if the move survives that midweek counterpunch, that's when you know you're not dealing with a cute bounce. You're dealing with a real repricing. Now I want to talk about the media silence effect, but I'm going to do it without naming outlets because the pattern is bigger than any one brand. When a story doesn't fit the comforting narrative, it gets minimized. it gets ignored. It gets pushed to the side. Then, once the price is high enough that ignoring it becomes embarrassing, coverage suddenly appears. Articles pop up. Panels talk about it. People who never cared last month become experts overnight. That's the moment retail piles in. So if you're watching this before the loud coverage arrives, you have a window. A window is not a guarantee, but it's an advantage. Now, let's zoom out to the global layer for a second. Silver isn't isolated. Demand isn't only one country. Physical premiums can show up in multiple places. Industrial demand doesn't stop because a chart looks overbought. Monetary demand doesn't stop because an article says, take profits. And once the global bid is there, the paper market can only mask it for so long. Which brings us back to the positioning problem. Commercial traders, market makers, big hedgers, when they're net short large amounts, they're betting that price won't run too far, too fast. But when price runs anyway, that net short becomes a trap. And traps are what create squeeze events. Now here's the part I want you to understand deeply. Squeezes don't end because you feel good. They end when the forced buyers are done buying, or when price breaks down hard enough to take options back out of the money and release hedging pressure. So the way you track a squeeze is not by guessing tops. It's by tracking whether the mechanics are still present. Are key strikes still in the money? Are miners still outperforming? Are dips being bought fast? Are earnings likely to confirm margins? If those answers remain yes, then the squeeze has fuel. Now let's talk about what you should not do. Do not let one green day make you arrogant. Do not let one red day make you panic. Do not size trades based on excitement. Do not ignore risk management because you saw a screenshot on social media. Squeezes are the fastest way to make money and the fastest way to lose money. The difference is discipline. Now, because this is a community channel, I want to bring you back into the conversation. If you've been watching silver and miners for a while, tell me in the comments, what was the first sign you noticed that something felt different this week? Was it the OPEX rebound? Was it the miner outperformance? Was it unusual volume? Be specific. And if you're new, tell me what you're trying to learn. Options mechanics, mining fundamentals, or just how to avoid getting played by emotion. I read these. They shape what we cover next. Now, I promised I'd circle back to success stories, and I'm serious about it. If you've had a win, whether you started stacking, paid off debt, built an emergency fund, landed a better job, drop it below. It doesn't have to be numbers, just share the story. People need that right now. All right, now let's rerun the logic chain one more time, quickly, because repetition is what locks it in. OPEX created a choke point. Price was attacked early. Price recovered and closed above the level that mattered. That close pushed calls into the money. Calls in the money forced delta hedging. Delta hedging forced buying. Buying in miners outran the metal. That outperformance signals the lever is active. Earnings next week could pour fuel on the lever. That's the structure. And structures are what create high retention runs in charts and in videos. Because once people see the structure, they don't want to look away. Now, let's talk about possible next moves, and I'm going to be blunt. If this continues, it will get emotional. We could see gap ups that make people feel like they missed it. We could see intraday dumps that make people feel like it's over. We could see headline fear designed to shake you out. We could see too late comments from people who haven't run the math. And your job is to stay centered and track what actually matters. So here's what I'm watching into the next 2 weeks. 1. Whether silver holds the high zone because miners can't keep sprinting forever if the metal collapses. 2. Whether miners keep showing 3-to-1 or 4-to-1 type days because that implies ongoing hedging pressure. 3. Whether volume stays elevated because squeezes require participation. 4. How earnings are received because good earnings can still sell off if expectations got too high. Now, there's another angle here that people love to ignore. Valuation relative to broader markets. Many broad market stocks trade at expensive multiples because investors pay for growth stories. Miners, even when profitable, often trade cheap because investors fear volatility. That cheapness is why they can pop so hard when sentiment flips. So when you combine cheap multiples, exploding margins, and a mechanical option squeeze, you get a setup that can move faster than people believe is possible. Now, I need to be honest with you. The people who win these moves are usually the ones who were positioned before the breakout. That's why I've been yelling about mechanics, not headlines. But even if you weren't positioned early, you can still avoid making the biggest mistake, chasing into the top of a single candle. If you're late, you wait for the market to offer you a better spot. Support, consolidation, dip buying confirmation. Because if this truly is the start of a multi-week repricing, it won't be one candle. It'll be a sequence. Now let me drop a quick short CTA that actually matters. Subscribe so you don't miss the next update, because in moves like this, timing is everything. Now, I want to add one more piece that people forget. When miners rise, they attract stories. Stories spread faster than spreadsheets. And once the story spreads, the liquidity changes, the volume changes, and the move can accelerate. That's why the first phase is quiet and technical, and the later phase is loud and emotional. We're at the edge between those phases right now. So if you're watching this, you're early enough to learn, early enough to prepare, and early enough to avoid being the person who only notices after the crowd arrives. Now, you might be wondering, John, what's the one thing that would make you change your mind? Great question. For me, it's simple. If the miners give back the move fast and close back under key support for multiple sessions, and the metal can't hold its own support, that would tell me the squeeze pressure didn't have enough fuel. But if we get consolidation above the breakout and earnings support the margin story, then the path of least resistance stays up. Now, I'm going to leave you with a final thought that I want you to take seriously. The market doesn't ring a bell when suppression breaks. It just stops working one day. And when it stops working, the move isn't polite. It's violent. Friday looked violent, which means next week could be the week where people realize they're underexposed, and they all rush in at once. Now, don't forget to check the description for those bonus links, including the premium WhatsApp channel and the membership option, plus that Silver Success Stories channel link I mentioned. And if you want those members-only videos with the heavier research, that's where you'll find them too. I'll be back with updates as this develops. Until then, keep your head on straight, track the mechanics, and don't let the noise trade your account for you. And seriously, drop your thoughts below. Are we watching the start of a genuine multi-week repricing? Or do you think the market tries one more big fake out first? I want to see your call in the comments. And if you think this is already big, wait until the next options wall gets crossed this month.